I'm with Michael Lewis, the head of ESG thematic research at DWS. Michael, it is great to see you. All this talk during the COVID crisis that ESG is at a tipping point. But what does that mean in practice?
We hear this phrase so often, and I think it started in research when people saw that there was more and more research telling us that ESG doesn't mean negative returns. Then we turned into technology and how technologies hit a tipping point where they're more viable than the alternatives such as fossil fuels. And then we turn to legislation and the more and more legislation coming through on ESG. Then we turn to public policy of Paris and SDGs. So we have a number of these things, all the investor and corporate initiatives, and we get very, very excited about it all. I think the problem is the proper tipping point is investment flows. How much money is actually going into addressing the Sustainable Development Goals? The UN tells us we need about $2.5 trillion every year. That's the financing gap. And if you look at impact investing, that market is about 500 billion. You've probably got in European ESG funds 700 billion, and in US ESG funds about 200 billion. So we are still so far behind when it comes to investment flows. But there have been a lot of tipping points, but the most important one is investment flows, and we're not there yet.
There's also a lot of talk about long-termism at the moment. But the long term is a series of short terms, and the market can only see the short term. How do we square that circle?
This is a really difficult question. And I think we've been struggling with this for almost, as you say, for a very long time. Mark Carney did a good job of explaining it very explicitly in The Tragedy of the Horizons. In a sense, I think what we need really is a lot more public policy to drive this move towards long-termism. And the reason I say that is that it can't be up to the financial community. We haven't done it yet. And I think we need the strong arm of government. And I think the other thing is that maybe what we'll see is more public opinion driving this. I mean, I think many of us here know that 3.5% rule, if the total population of that 3.5% go out and demonstrate, a bit difficult now. We can't go to Trafalgar Square or Times Square or Tiananmen Square at the moment, but if we see more and more public policy and public opinion moving in this direction, then I think we can start to see a move towards this long-termism. And just to sort of finally say, we've got a really good test case coming at us at high speed as it relates to government policy on this. Will they bail out the oil companies? Will they bail out the airlines? Will they bail out these high carbon sectors? If they do, then we've destroyed this idea of long-termism. And more importantly, what will they do in terms of their long-term stimulus programs? Will they be green infrastructure programs, green infrastructure, green jobs? The signs are encouraging, but we just don't know yet the composition. So I think for me, this idea of long-termism, the first test comes on the government and it rests on them.
What is the message to clients, or what are clients telling you?
Well, I think for us, for clients, it's very much ESG. There is this discussion of, is ESG, is it a luxury? Is it a fad? Is it going to be thrown out the window because we've got to get the economy going? Or is it actually something that is much more powerful and will accelerate now? And our feeling is, and I suppose I'm in ESG, so I would probably say this, but if you look at companies and how they're responding, corporate reputation is going to be critical. It will be won or lost on their ESG credentials, and particularly on their social support mechanisms that they are bringing to look after their employees, their contractors, and their customers. So that's very important. For an asset manager, we're going to look much more at the social aspects and integrating S into the investment process, which has been a little bit overlooked because of all the climate risk that we've been looking at. And then it's going to be very much a focus on impact funds. It's going to be looking at microfinance. Emerging markets are very exposed to this. They can't self-isolate in a one-dwelling home. They can't wash their hands a lot if there's not good sanitation. And they can't work from home if there's no internet. So microfinance, I think, ticks a lot of those boxes. And I guess another area for us that we're talking about is agriculture. This will be a very important investment theme going forward, particularly as we try and address biodiversity loss. So I'd say those are some of the themes that we're talking a lot with clients, and how do we allocate capital to those types of solutions.
So what ultimately does asset management look like after this crisis?
Well, I think the most important thing for asset managers is that they need to measure their impact and they need to be reporting robustly. And I think we've got to absolutely stamp out this greenwashing and social washing, and companies will be punished if they're seen to be overstepping the mark here. So I think there's going to be a lot more scrutiny on the investments that we have as an asset manager, a lot more scrutiny, and good. I'm so pleased that there are more and more NGOs scrutinizing proxy voting track records. How are asset managers voting according to climate resolutions and broader ESG resolutions? I think that's going to be another sort of big theme. So I think we'll see much more focus on what asset managers are doing in their investments and in their engagement and in their disclosure. So for me, I hope it's going to be a much more robust sector and a much more scrutiny on us, and actually to deliver and to show what we're doing.
Michael, thank you very much.
Thank you.